sells for a whole lot of money. Let's talk for a minute about venture capitalists. As I said, they typically invest through preferred stock. What this means is, founders, employees get common stock, and preferred stock is really just what it sounds like. They have rights and preferences that are senior to the common stock. And in the typical Series A VC round, this is just a kind of rough range. You often see VCs getting somewhere between 20 and 50% of the company at a negotiated pre-money valuation for the company. And oftentimes the pre-money valuation for a Series A company I see it in IT, I also see it in clean tech, in many sort of domains within clean tech, for a very early stage company might be in the $2 to $10 million range for a valuation. The kind of rights and preferences that, what are you going to have to pay to get this venture money? What are you going to have to give up? Well, they're going to expect that they get their money out first. That's called a liquidation preference. There are little nuances in liquidation preferences. Sometimes they ask for twice their money back. That's pretty rare in an A round. And sometimes they agree that if the company sells above a certain level, that they're just going to be treated like common shareholders, and they're not essentially, if there's enough money to go around so that they get their 1x back or whatever, they just kind of join in with the herd and take their pro rata share. They tend to have special voting rights as a class in protective provisions that say that you can't sell the company or bring in new investors or loan a bunch of money or grant exclusive licenses to your IP and things like this without their permission. They have anti-dilution protection typically, so that if the next round of investment is at a lower valuation, that they're not harmed unduly by the fact that you had a down round. They typically have the optional right to convert anytime they want to, and in certain scenarios they often, or almost always, are required to convert into common stock. One really important thing, it's seldom used, but it highlights the kind of interest, the kind of string that comes with venture money. They tend to have a redemption right, so in like 5 years, they have the right to put the stock back to you if there hasn't been an exit and say, you have to buy this back. We want out of this company. And that right is seldom used, but the reason it's in there, and it's an important thing to understand about venture capitalists, is that they have what's called a life of fund issue. They typically raise money in a given year, and the fund might have a life of 10 years, and they're going to spend the first 2 or 3 investing that money, and you might get money in year 3. They expect you to have an exit, in 5 or 7 years tops, so that they can get their money out, and that kind of puts you on their timeline. They have dividend rights, rights to participate pro rata in future financings, registration rights, rights to force you to go public under certain circumstances, board seats, and other rights like rights to join in the sale of their shares if another shareholder sells their shares at a price they like, things like that. So that's what a venture capital round might look like. But the $64 million question is, is venture capital even available for the clean tech company? Well, venture capital investment has been down the last couple of years, and IT and healthcare, including biotech, still dominate VC investment, and they really dwarf clean tech. The highest reported number that I've seen from various studies for clean tech investment in 2010 was 7.8 billion. Well, that's good news. It's up 28% from 2009, but it's still behind 2008 levels. And the projection for clean tech VC funding in 2011 is essentially flat. Clean tech investment actually slowed in the last couple quarters of 2010. And VCs are still, the VC industry is in turmoil at the moment. And VCs are still cautious about many clean tech plays because they tend to be capital intensive. There are VCs that invested enthusiastically in biofuels companies, for instance, and found that a lot of the lab work wasn't yet done and it was expensive to complete. And that, Chevron's or BP is not just going to license your clean tech molecule and go into production. They're going to want you to start have a test facility, biorefinery. And gosh, we didn't sign up for that, says the VC. We didn't know about that. We don't know anything about project finance. Same in solar. And they've been forced over the last decade or so to learn something about project finance and to partner with the investors in that realm. In many of the clean tech VCs I know and represent are kind of tending more towards less capital intensive clean tech investments, at least at the moment. It'll be interesting to see how things shake out. The good news for people in this room, I would think, is that what VC money there was available in 2010 for clean tech went disproportionately towards solar investment opportunities. If you could get venture capital, do you want it? Should you want it? I said this was the age of light startups. A lot of entrepreneurs are really trying to go without venture capital. I have several clients who are really making a go of it, and some who are succeeding. The pros of taking venture capital are if you're doing something that's capital intensive and that's risky. This is all risky. I have friends and clients who are spending their life savings on their companies. They're just such true believers. I mean, they're taking a lot of risk. Third-party money mitigates that risk, and if you perform well, the right venture capital essentially are going to bankroll your company through a successful exit. You'll give up a big chunk of your company, but you'll have a smaller piece of a much larger pie, most likely. And some VCs really can provide helpful guidance and context. One of our VCs at Groove was on the board of directors of Walmart, and Walmart became one of our biggest customers. Cons, well, you're going to become a minority shareholder over time, most likely. But the gamble you make is like I